After the big crash, the world is indeed witnessing a fundamental reassessment of sorts as far as emerging market economies are concerned. So where does India really stand amidst this global rout? On the big reset here on ET Now, we have the country's finest minds to assess the situation and answer some of those very pertinent questions. Getting you the perspective amidst all this panic, it is my pleasure indeed to welcome on this show Mythili Bhusnurmath, Dr. C. Rangarajan and Dr. Shankar Acharya. I'm Supriya, Shrinate. Thanks very much each one of you for being with us and patiently standing by for this special broadcast. Mythili, I'm going to begin with you. There are plenty of tailwinds that India is witnessing. Some headwinds, yes, but at a time when it's risk off in the global financial system, especially in the emerging market economies being looked at with a lot of suspicion. Where does India stand amidst this global rout?
Well, Supriya, the fact is that yes, we are, relatively better placed as compared to other emerging markets, but that's not good enough for a country like ours. Because let's accept it, when we compare ourselves with Brazil, with Russia, with China, and any other country that we look at, these are countries that are far more prosperous than India. So we will get affected by the global tailwinds. They will drag us down also. The question is, can we afford to get dragged on? Because we must remember, not only are we poorer, we are also a much truer democracy in that sense. So we have real anxieties about what kind of pain, as far as the real economy is concerned, what kind of pain does this translate to? So just being better than others is not good enough, because we will get dragged down along with the rest of the world. The fact that we get dragged down a little less, I think, is no consolation whatsoever.
That's right. Sir, essentially, Mythili is talking about how India is a poorer country and we have a democracy to take care of. So, yes, we will be dragged down by global factors. The question that's coming your way, Dr. Rangarajan, is, and because you've been a part of policy making for decades, how does India navigate through a global rout, a global crisis like this? We are looking at a big reset, even of the macroeconomic fundamentals. Crude oil is just one factor there.
Well, I think there are immediate problems to be handled and the short-term or the medium-term problems to be dealt with. The immediate problem is arising out of the depreciation of the Chinese currency and its impact. My feeling is that if China stops with the depreciation, which has already happened, then probably the possibility of a currency war, the possibility of competitive depreciation will not be there, and that will be good for India and that will be good for the rest of the world. But if China, on the other hand, chooses to give another dose of devaluation or depreciation, then it will have problems. So I believe that the short-term problem is with respect to the currency, but the medium or the short-term problem will be that what happens to the Chinese economy and its impact on the rest of the world. The Chinese economy is today rated as the second largest economy, and if its growth rate goes down, then it will have its impact upon India and many other countries which are trading with China. Therefore, what we really have to see is that whether we can revive the growth within the economy by focusing more on the domestic factors. This is true of many other countries as well. I think China also is turning more towards domestic factors to stimulate the economy. We should really act in such a way that the Indian economy can revive by focusing more on investment and trying to see the productivity of capital is increased and get on to a faster rate of economic growth. All the question about the fundamentals being strong is good, but we really need to make the fundamentals even stronger to be able to withstand the impact of such changes.
That's a very valid point that you're talking about, that everybody is talking about these strong macroeconomic fundamentals, and yet they did not come to the rescue when the big crash was happening. Dr. Shankar Acharya, I'm going to pull you into this discussion right now. Why is it that our strong macroeconomic fundamentals, and they're not belying, our twin deficits are under control, inflation is well within our control, growth was just about beginning to look up. Why is it that those factors did not come to rescue when the big crash happened? Why is it that those factors were ignored by market participants? Are we going to see a reset there as well?
Well, first of all, I would not overdo the scale of what is being called a crash. Remember that even in the China's case, if you're thinking of the crash in terms of what's happened in the stock markets, my understanding is that the Shanghai Composite Index today is still 30% higher than what it was a year ago. Basically, during the course of last year, you had an enormous bubble build up in Chinese stock markets. And during the course of much of this year, that bubble has now gradually deflated, and most recently not so gradually. So that's one dimension. In that context, of course, because of the fact that China is such a large economy, and even though its stock market is not that well integrated with the rest of the world, there is a impact all over the world. Partly, of course, because there is fragility all over the world as well. Aside from the United States, as you well know, in Europe, the situation still remains subject to the uncertainties of what's going to happen in the Eurozone, particularly with regard to Greece, where a new snap election has been recently called by the current Prime Minister. In many of the former commodity producers, or existing commodity producers, like of course in the Middle East, Russia, Brazil, Indonesia and so forth, the overall slowdown in the real economy in China in the last year or two has led to the drop in commodity prices, including oil. Now, while it has benefited countries like us, it has hurt a large number of countries. So there is a certain amount of fragility in the world economy. So it's against that background that the Chinese stock market correction, and I would still call it a correction rather than a reset or a wipeout or anything like that, has had its impact. Why didn't our so-called strong fundamentals protect us? Well, you could argue, and some people have argued, that our own stock markets were a little bit too, shall we say, optimistic or ebullient in the most of last year. And this year it's been volatile, and this was seen most recently in the last couple of days. Also, in the real economy, there are some elements of weakness. It's not all strong fundamentals. In the banking sector, particularly the public sector banks, as we all know, they are significantly weighed down by non-performing assets and restructured loans. So their capacity to do fresh new project financing is a problem. We also have major bottlenecks in infrastructure in many areas where new investment is not occurring, and old projects are tied up in all sorts of problems. So it's against that background that I would see it, and I would really revert to what Dr. Rangarajan was saying, that what we need to do in the current context is focus on the domestic economic problems and resolve them to the best of our ability, whether this be in the banking sector, whether this be in infrastructure, whether this be in preparing for fiscal pressures, say from the next pay commission and so forth.
Fair point indeed. Mythili, I'm going to bring this to you very quickly, because the global trend that one is seeing and that impacts India very largely is that we are going to see the soft commodity universe, and crude is one such factor that impacts us. Many people are rejoicing that, you know, $40 a barrel crude, we couldn't have asked for anything better, but policymakers don't really think so. They believe that it is a sign of a very soft global growth as well. Which side of this debate are you on?
Well, commodities have always been very cyclical, and recently they have been pretty volatile. So if this is just an adjustment, a correction as Shankar calls it, whether it's in currency markets or commodity markets, it is not so worrisome. It might be net beneficial to India. But if this reflects a larger, more worrisome structural slowdown, particularly of the Chinese economy and of the global economy at large, then it is certainly a cause of worry. I would think that, yes, at the moment, it doesn't seem like it's going to be a major structural problem. It does seem to be part of the commodity super cycle, which has ended, and a new phase, a bear phase in commodities. As long as that ultimately reverts, I think it's fine. We have a window of opportunity. We had one window of opportunity soon after the government took over, the new government took over. We really squandered those opportunities, and now we've been given a fresh lease of life. I think we really need to cash in on that opportunity, Supriya, and then maybe things would look up, and net we could gain from this crisis that's embroiling the entire world. But Dr. Rangarajan, if I could come back to you on the question that, issue that Shankar had raised, he said one should look at this as a correction, especially as far as currency is concerned, because the rupee did need to be corrected. But that brings me to our next question. Would the depreciation have been less marked? Would it have been less sharp had we allowed the rupee to reflect its fundamentals? Because the rupee had been overvalued for a considerable period of time and had been artificially held up, as it were, because of strong FII flows. Now, had we been cognizant of this and allowed the rupee to reflect its true value, then maybe the depreciation would not have been so sharp. And what markets dislike most of all is sharp corrections. So should the RBI have done a little bit more? As a former governor, should the RBI have done a little bit more really to correct the value of the rupee?
Well, you must distinguish two things. One is what needs to be done about the exchange rate and what happens under special circumstances. Even if the rupee had been somewhat corrected earlier, the overvaluation has been brought down. When a situation like this happens, when there is a sudden depreciation in a major currency, then it will have an effect. I don't think that there would be a moderation just because of that. I don't think so, because these sudden events happen. When these sudden events happen, it will have an effect upon the currency of many countries. In fact, what is happening today is globally everywhere, every currency is getting affected, except of course the dollar, because it is measured in terms of a dollar. But coming back to the basic question, yes, I think we should not let the rupee get itself overvalued. There are differences of opinion regarding how much overvalued the rupee is. But the correction for it is not in a time of crisis. The correction for it is over a period of time. I would certainly argue for a situation in which the Indian rupee does not get overvalued in real terms. We should correct it. But that does not mean even a well-corrected currency cannot come under stress when global events happen.
Absolutely. Currencies are always under threat at any particular point of time. But Shankar, if I can turn to you, if you remember in 2008, the talk really was of the yuan being undervalued. And the US put a great deal of pressure on the China to revalue the yuan. And now we're having exactly the opposite situation. So is it the case that currency and exchange rates really had nothing to do with the global financial crisis? Because if you remember, that was one of the reasons advanced for the global financial crisis, that China had export-driven growth with an undervalued currency. And as a result of which they was able to build up huge balances which they invested in US treasuries, and hence you had the subprime crisis because you were looking for financial engineering and US investors looking for yield. All the rest of it, China was blamed for having kept its currency artificially cheap. And now we're having the reverse situation. So does currency really have nothing to do with the kind of global currency wars we're seeing? Is exchange rate something that's completely irrelevant?
No, I don't think, I'm not sure what you're getting at here, but I don't think that currencies are irrelevant either for individual countries or for a group of countries. The real part of the Chinese economy slowing down, and this is really happening after perhaps a period of 30 plus years, from essentially close to double-digit or above double-digit rates of growth to officially 7%, but some people say that actually the Chinese economy may not be growing much above 5%, even if 5%. And that's a remarkably sharp slowdown in a short span of time for a $10 trillion economy. It's bound to have effects not only in China, which it is obviously having, but its effects will be felt across the world, particularly on those economies in Eastern Asia, Southeast Asia, and wider spectrum, which are connected through both trade, capital flows, and pure confidence factors to China. So we are seeing that. And this whole kind of view that after about, say, 2012, emerging countries seem not to have been doing well. We were very resilient during the global financial crisis, if you take the emerging countries as a whole. But after around 2012, you do see, for a variety of reasons, some of them country-specific, a significant slowdown in some of the major emerging countries, which I mentioned earlier, whether they are Brazil, Russia, or India also. You recall we had our own economic slowdown significantly from around 9% to 5%, and people now say we are growing at somewhere around 6 to 7%, but there's some doubt as to what the numbers are. And so there is this question of the momentum of growth in emerging economies apparently having slowed down significantly. And against this context of what you might call some fragility, the kind of reset, as you call it, happening from China, and I would really focus at least as much as on the real economy of China as on the financial markets that one tends to see day by day in terms of stock market prices coming down or currency being devalued and so forth, that it is that which has had a significant impact against a background of a possibly slowing momentum in emerging countries.
The big talking point in India is also the possible threat of deflation being exported to the rest of the world from China. Where is India amidst it all? We are also seeing our own inflation figures go down. It's a welcome sign, but WPI has been in the negative territory for a while now. Is there any threat of deflationary trends taking ground here?
I don't think so, Supriya, because in India we always have an underlying inflationary bias. And if you look at the CPI, it is still fairly high as compared to the rest of the world. I'm not saying it's high by Indian standards. By Indian standards, it's certainly low, quite low. In fact, it's less than what the RBI's target for January next year is concerned. But as compared to the rest of the world, we still are, I think, above the global average. If you look at countries, of course, apart from certain countries maybe in Africa in some extreme cases. So I don't think deflation really should be a fear in India. The fact is that we've got, again, as I said, this window of opportunity of low inflation, and hopefully if inflationary expectations come down, the RBI may be able to take some action. Though of course the depreciation of the rupee has largely achieved what a rate cut could have achieved. So I think on that ground, as far as deflation is concerned, I don't think it's a cause of serious worry for us really at this point of time.
It's an important point that you're bringing to the table, because that was my next question. Dr. Rangarajan, in this very dynamic global situation, as far as our own ammunition is concerned, do you believe rate cut is an ammunition that should be put to use right now, or is the situation far too volatile and one would like to hold their horses at this stage?
Well, if you look at the domestic situation, perhaps if the inflation trends continue in the same direction or remain more or less at the current level, there is a case for perhaps for a reduction in the policy rate. Because the CPI inflation is below 4%, it's within the comfort zone, and therefore a policy rate reduction is quite justified. Perhaps last time it was not done because one was not very sure about how the monsoon will turn out to be. That concern still remains, but if the overall trend is in that direction, the policy rate cut is perhaps justified. But the only thing that can clear the pitch is what happens in the global economy. As we have been discussing, the impact is not only on the exchange rate but also on the real sector of the economy because of what happens to the real sector of China. Therefore, we need to watch out the full implications of the decline in the growth rate in China. So, if the global situation does not deteriorate too much and it does not produce any shocks, then perhaps a reduction in the policy rate by the time of the next policy statement may be justified.
Fair point indeed. That will be justified, and that's a voice that matters. But Dr. Acharya, I'm going to ask you a question that is still not in the realm of reality right now, but no sooner it is going to gather momentum. There is going to be a clamor for a fiscal package. I was quite amused to find out that when Finance Minister spoke on the day, markets corrected very, very sharply. People were already beginning to talk about fiscal incentive packages. Can India at all afford one? I mean, we've already seen what we did in 2008. It took us 4 to 5 years to get out of that fiscal mess. Our inflation went out of hand. Can we at all look look at a fiscal incentive package if the need arises too?
I would say no. I think our kind of fiscal policy generally has historically been biased in favor of being too expansive, that is, running large fiscal deficits on an almost secular basis. So against that background, we should be very cautious about consciously and deliberately doing what's called fiscal stimulus and fiscal packages and so forth. And I completely agree with you that this is not the time, I think, especially bearing in mind that there are a couple of things down the road which will in fact lead to higher expenditures for different reasons. The two things that I have in mind are the final government decision, whatever it is, on this whole one rank, one pension issue, which could prove to be expensive in the short and medium run. And secondly, of course, on the pay commission's recommendations and how they are dealt with, that too is not far away. So against those, if you like, foreseeable and predictable eventualities, this is not the time, I think, to suddenly open the tap on government expenditure to try and solve problems which are really elsewhere. I think our bigger problems, as I mentioned in the beginning, were in the banking sector, in the quality of balance sheets of public sector banks, in their management, in their governance and so forth, as well as, of course, on this whole business of project execution and infrastructure bottlenecks and so forth. And that's where the supply side issues that we need to focus on, rather than trying to sort them out through fiscal exuberance.
Fair point indeed. We're running out of time here on the show, but Dr. Acharya, I'm going to very quickly ask you the big question, and that's this is the big reset. Are we going to expect a bigger reset when the Fed eventually does bite the bullet and begins to raise rates? I think with this so-called mini crisis that's now going on, it's very unlikely, in my view, that the Fed will actually raise rates in September. I think there is some possibility, but I would certainly put it at less than 50%, perhaps even less than 40%. So that's my view on in terms of whether it happens or not. Now, if it happens, I think obviously it will depend on whether by how much. It's most likely to be a nominal amount. I don't think that you will see any huge consequences, because most countries are in some sense prepared for it. They've been through taper tantrums a couple of years ago, so they know what it's all about, and that's certainly true for India. So I would not, while it'll have some consequences when it happens, I don't think they will be very, very severe. And in my view, I don't think that you will actually get an increase this September, now that you've got all this other uncertainty, volatility and turmoil going on in some parts of global financial markets and in real economies for that matter. Fair point indeed. I'll let Mythili have the last word on this. Mythili, very quickly, we started the show with tailwinds versus headwinds. Are you someone who's going to be scared in India as far as tailwinds are concerned, or are you reassured with the headwinds that are in our favor?
I think we need to proceed very cautiously, because though Shankar said that it's unlikely the US will raise rates in September, the fact is we are living, on borrowed time. At some time the Fed will raise interest rates, and the Fed has always looked to its own backyard. They make noises about the rest of the world, but frankly the Fed, like any other central bank, always acts in its own interest, and that might not coincide with our interest. So as and when the Fed reverses interest rates, we will face tailwinds, and quite severe tailwinds. How severe? How bad we'll be affected, that perhaps is something that is within the government's control, but not entirely. So I think we are in for quote-unquote interesting times.
Dr. C. Rangarajan, Dr. Shankar, Acharya and Mythili Bhusnurmath, it is indeed a pleasure to be speaking to each one of you, one of the finest minds in the country that I spoke about earlier on, the big reset. Where does India stand amidst this global rout? Thanks very much for being with us. Thanks, viewers, for watching us.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.